Nvidia reported another quarter of strong growth, beating expectations, uh, both the top and bottom line, revenue and EPS. But, and we currently don't see it in the charts, prices fell because it traded after market hours. So this is not reflected in this particular chart yet in CFDs. However, we expect prices to be around the 175 when the markets open. And this is because data center revenue came in just below forecasts. And also, no China H20 chip sales were included due to ongoing regulatory uncertainty. Now, with Nvidia stock a central driver of Nasdaq performance and market risk, given that this rally to new records for the indices as well as Nasdaq itself has been driven by um, AI, artificial intelligence, and cloud. Any further downside in Nvidia could, although currently is not reflected in the indices, could signal broader bearishness for the markets, for risk sentiment. Given, of course, the index extreme concentration in a handful of tech giants and the outsized influence of Nvidia's result on sector sentiment and risk settlement across the market. If not mistaken, I think there was a recent report saying that Nvidia represents around 4% of the S&P 500. In short, any continued weakness with the open today and probably Friday, because it's, of course, we'll have another trading day for the week, um, is not just going to be reflecting the company specific headwinds, but also poses a systematic risk for the Nasdaq and tech sector as a whole. And that's why it's important that we are here and we are checking what's happening. Now, let's just quickly look at what's happened here over the past few weeks and months. We've experienced a double bottom here, and we saw prices moving up to around 185. Given that we have a lower low and a lower high over here, we could just come and first of all, we would put a channel out here, connecting the tops and or connecting the bottoms, or both actually are kind of in that manner. They connect with one another, if that makes sense. So we are. I'm assuming that prices are going to open just right at this median line, right? What is more important to look at um, is the moment we see this upside, this downside reflecting in the markets, we would want to have a look at a potential bounce, right? Why? Well, because this decline, guys, it's probably going to, it could turn into a dead cat bounce, right? Which means that we go and place our Fibonacci down to the level that to the low that we are going to see in the next few hours, and any upside, any rally, the Psychos rally as called, up to the 38.2 could potentially be followed by further weakness, further downside, right? So there is two ways. There is actually three ways to play this. One is the aggressive entry, the breakout of the low at 175 or so, whatever that will be. Another one is the a little bit more conservative approach, waiting for the rally to create resistance at the 38.2. And another one, which is the most conservative but less uh, rewarding, if you may, would be a third um, entry after the breakout of that low and a potential retest of that support. I'm personally more interested in doing something like this. Uh, after I see an initial leg to the upside, after I see an initial leg to the upside, I would prefer to um, come and enter somewhere between the the potential leg to the upside, somewhere between the middle. So typically we would see this moving into three waves. So I would be looking to enter at the bottom of that particular low, if that makes sense, right? And obviously, one of the first levels take into account would be the previous low, and the stop would be placed above the 50 or above even the 61.8, if you may. It is typically not not a dead cat bounce if we go beyond 61.8. Actually, as we go above 38.2, the risk of this being a dead cat bounce is increasing, which means the higher we go, the less the chances that this is going to be that. Now, um, this still is providing a good risk reward ratio. Okay, and if we look at it a little bit, if we just zoom out a little bit as well, right? What we're going to see here as well, because that doesn't necessarily mean that this is going to continue going lower down, right? I am not um, particularly bearish in the medium term, if that makes sense, because we see prices being indeed in a bearish sort of a sloping, I would say, downward sloping channel. That doesn't necessarily mean we're going to break lower though, because we have one, two, three, and four, two lows, two highs over here, and a potential consolidation. This sort of consolidation could be followed by another leg to the upside. The results of Nvidia are not good for Nvidia and the CEO of Nvidia, but any other company would be wishing for these results. And coming out at this particular point, I am particularly interested in looking at the distance between the bottom and the breakout level. This is the measured move approach. And at the breakdown, at the breakout, what we are looking is prices perhaps going all the way up to 220. Of course, this is the measured move, which means we are looking at the equal extension. However, we could also use the Fibonacci to see where the 61.8 brings us. This is around 193. Okay, and then the 78 and the 100, 220, as we say. So 193 is going to be a very important level. Now the question is, does this level is this level close to any of the shorter term sort of Fibonacci levels so that we can look for clusters? Well, actually, if you see at the 61.8 of that leg, the short-term leg and the larger term leg, they both come around the $194. This makes this level very, very, very important. But obviously, we're talking about a few months down the line, probably, and assuming that we're going to see this, of course, um, playing out in the way that I described. But as I said, short term might be bearish, but I think medium term we might see that actually turning. If we don't, then the risk of a drop down to this breakout level around 172 is going to increase. Okay, for long positions, it would be an aggressive entry would be at the bottom. We can say even at the double bottom here. At, let's just call it 170. We'll be looking for stop losses to be below that particular low, and initial targets would be around the first, um, the previous record high at 183. This also has a very good risk reward ratio of 1.8. But given, of course, the risk of potential decline, I would be letting that go down there to 170 and see how this pans out at this level, how sentiment is going to be um, around the 170 level.